Hello everyone, welcome to Insight Lens, the channel where we dive deep into the stories behind world-changing technologies and economies. In today's video, we break down China's deflation, how it started, why it's lingering, and what it means for jobs, investments, and supply chains worldwide. CPI dipped as low as minus 0.7%. PPI has fallen for 33 straight months. Youth unemployment hit 20.8%. And policymakers are trapped between capital flight and stagnation. Let's get into it.
This technological gap makes it very difficult for China to catch up. So what options does Beijing have? In the short term, they can only use moderate stimulus packages, focus on stabilizing the job market, and partially support real estate. But the key lies in the long term, enhancing domestic consumption, reducing dependence on exports, and accelerating self-reliance in technology. This will require reforms in both the economic and political systems. It will not be easy, but without it, China risks falling into the same trap as Japan decades ago. So what lessons can we draw from this? Perhaps the most important one is, speed is survival. In a world that changes faster and faster, any hesitation can be very costly.
All are part of the story. The risk is not only economic decline, but also social instability. And that's what makes Beijing's task so urgent and so difficult. If deflation is not controlled in time, it could undermine trust in the government and in China's growth model itself. That would be a shock far greater than just a few quarters of weak GDP. It would strike at the very foundation of China's economic miracle. For the rest of the world, the lesson is clear and sobering. No matter how powerful a nation becomes, it cannot escape structural weaknesses. No matter how large the market is, confidence can vanish overnight. And no matter how fast you grew yesterday, tomorrow's slowdown can still arrive. China's deflation is not just a Chinese problem, it's a warning. A warning that growth without reform will one day hit a wall, and that even the biggest economies can stumble when speed slows down. Perhaps the most important lesson is this: in the 21st century economy, speed is not just advantage, it's survival. If you fall behind, you lose. And in today's global competition, there is little room for second place. For China, the next few years will decide whether it can reinvent itself or be trapped in stagnation. For the world, the message is simple: watch closely, because what happens in China will not stay in China. This is Insight Lens. Thank you for watching. Don't forget to like, share, and subscribe for more deep investigative stories.
Since the beginning of 2025, China has continuously fallen into deflation, meaning that the prices of goods and services have steadily declined month after month. The CPI fell to its lowest point, hitting negative 0.7% in February and remained at negative 0.1% for 3 consecutive months. But looking only from this year alone is not enough. This wave of deflation actually started to emerge in mid-2023 and has by now lasted for nearly 2 years. The notable thing is that since the financial crisis of 2008, China has never experienced a deflationary period as severe and as prolonged as this one. So what is really happening to the world's second largest economy? Welcome to Battle Cry. Let's explore. The stomachache called deflation. If a decade ago, whenever people heard the word deflation, they immediately thought of Japan, a nation that once fell into a prolonged economic stagnation, with prices frozen, wages stuck, and an entire society sliding into inertia. Today, however, that phrase is being repeated with increasing frequency when talking about China. And what makes observers uneasy is that this time deflation is no longer a short-term market slip, but is gradually revealing itself as a chronic economic condition. It is smoldering, spreading, and extremely dangerous if not addressed properly. In June 2025, China's Consumer Price Index, CPI, stood at plus 0.1%. At first glance, this looked like a positive signal, since at least after 4 straight months below zero, consumer prices had finally turned back to positive. Yet, this was only surface paint. In reality, China's economy has still been trapped in a technical deflation lasting nearly a year and a half, from early 2024 until mid-2025. For more than 15 months, CPI continuously fluctuated between negative 0.5% and negative 0.2%, at times plunging to negative 0.7%. What is more worrying than the numbers is the psychological effect it creates. When prices keep falling, consumers begin to postpone spending, expecting that if they wait, things will get even cheaper. Businesses also become more cautious in production and investment, fearing that their goods will not sell, or, if sold, will fetch prices below cost. And so a deflationary spiral forms. Weak consumption, shrinking production, layoffs rise, incomes fall, consumption weakens further. The economy then falls into a deflationary trap similar to what Japan once suffered and struggled nearly 30 years to escape. On the supply side, the picture is no brighter. The Producer Price Index, PPI, continued to fall deeply, down to negative 3.6% in June 2025, marking the 33rd consecutive month of decline. This means that for nearly 3 years, Chinese manufacturers have had to sell products below expected prices and sometimes even below cost. Reuters called this the longest decline since the 2008 financial crisis. This has gradually eroded Chinese industrial profits, placing severe pressure on investment, employment, and medium-term growth. According to China's National Bureau of Statistics, just in May 2025 alone, industrial profits fell 9.1% compared to the same period the previous year. If accumulated over the first 5 months of the year, profits of Chinese industrial enterprises had fallen by 16.8% compared to the same period last year. These numbers are not just dry statistics, but signals of increasingly heavy pressure weighing on the Chinese economy. In simple terms, both consumers and producers are losing confidence. People are hesitant to spend, businesses hesitant to produce, and that is the most dangerous symptom of deflation. Because when confidence is lost, no matter how much stimulus is injected, it is like pouring water into the sand. What then is causing this deflation? First, it's the aftershocks from the COVID-19 pandemic. The strict zero-COVID policy over nearly 3 years left Chinese households cautious, fearing instability and thus tightening their wallets. Consumption demand has since been slow to recover. In parallel, the real estate sector, which once accounted for nearly a third of GDP, has plunged into crisis. The collapses of Evergrande, Country Garden, and a series of real estate giants not only wiped out household wealth, but also destroyed confidence in what was once a core growth engine of the economy. Secondly, external demand has also weakened. The world economy, after a long period of interest rate hikes to fight inflation, is slowing down. Global consumption is falling. Orders from Europe and the US are shrinking, directly impacting Chinese exports. In June 2025, exports fell by 8.5% compared to the same period the year before, marking the largest decline since early 2023. Third, government stimulus has so far been relatively restrained. Unlike in 2008 when Beijing launched a massive 4 trillion yuan stimulus package, this time the Chinese government has been cautious, worried that a flood of credit could worsen already high local debt. Instead, policies are more scattered, such as supporting electric vehicle purchases, renewable energy projects, or small consumer loans, but these are not strong enough to reverse the downward momentum. As a result, China is facing a dangerous combination: falling consumer demand, collapsing real estate, weakening exports, and insufficient government support. Deflation is no longer just a temporary symptom, but could become a structural illness if not decisively treated. So how dangerous is this illness? Let's analyze more deeply.
to fully escape the shadow of deflation. China, with its current scale and complexity, could face even greater risks. If deflation persists, the first sector to be hit will be employment. China currently has about 11.6 million new graduates entering the labor market each year. Amidst weak demand, businesses shrink hiring, and unemployment among young people rises sharply. In June 2025, youth unemployment hit 20.8%, a record high, and a warning signal that a lost generation could appear if the economy does not recover soon. The second sector at risk is investment. When prices keep falling, businesses have no incentive to expand production. They fear that products made today will be sold tomorrow at lower prices. Investment slows, technological innovation also stagnates, and the whole economy falls into a vicious circle. Thirdly, government debt will become an even heavier burden. Local governments in China have accumulated debts of over 92 trillion yuan. In a deflationary environment, tax revenues fall while the real value of debt increases. This makes it much harder for Beijing to use fiscal tools to stimulate growth. Finally, the risk is not only economic, but also political and social. High youth unemployment, combined with a prolonged economic slowdown, can create social instability, something the Chinese government is extremely concerned about. So is there a way out? Looking back at history, the answer is yes, but it will not be easy. The United States, after the Great Depression, only escaped thanks to large public investment and then World War II. Japan, despite decades of struggle, has still not found a complete cure. China today has some advantages, such as a large domestic market, a strong manufacturing base, and an increasingly powerful technology sector. But it also faces huge challenges. First is the real estate crisis that cannot be solved overnight. Second is the dependence on exports while global demand is falling. Third is the difficulty in advancing in advanced technologies due to restrictions. For example, ASML of the Netherlands has completely stopped supplying EUV lithography machines to China. Without this, Chinese chip foundries can only stay at older process nodes, such as 14 nanometers and above. Meanwhile, the world is already heading towards 3 nanometers and 2 nanometer chips. This trend could reshape global supply chains in ways we haven't seen in decades. If China once became the world's factory, thanks to cheap labor and massive scale, its current slowdown might accelerate a global shift away from over-reliance on a single country. And that would mark one of the most profound changes in globalization since the 1990s. The world may be entering a new era where supply chains are more fragmented and resilience becomes more important than just cost efficiency. China's struggles today could be the trigger that speeds up this transition. So while deflation looks like a purely domestic economic issue, its ripple effects are shaping the very structure of globalization. And once that structure shifts, the world will not go back to the same. This is Tesla in China, ASML in Europe, or TSMC in Taiwan, all have proven that only those who move at breakneck speed can lead the race. China once had the advantage of speed when it opened up and joined globalization. But today, that speed is slowing down. If this trend continues, the future of the world's second-largest economy will face enormous uncertainty. And that uncertainty is not only a concern for China itself, but for the entire global economy. Because when the world factory and the largest consumer market slows, no country can escape its impact. From Wall Street to Frankfurt, from Tokyo to Vietnam, all are watching closely what will happen in Beijing. And perhaps the final lesson is this: no economy, no matter how large, is immune to the laws of growth and decline. China's story today is a stark reminder that economic miracles cannot last forever without structural reforms. And that speed, yes, speed itself, is not only a strategy, but also survival. This is Insight Lens. Thank you for watching, and see you in our next investigative story.
China's deflation problem is no longer just an internal issue. It has become a story that the whole world must follow. Because when the supply chain slows, when demand from the world's largest consumer weakens, every country will feel the consequences sooner or later. Factories in Germany, electronics manufacturers in South Korea, farmers in Brazil all depend on China's demand. If that demand shrinks, global growth will inevitably be hit hard. But there is another angle worth noting. Deflation can also make Chinese exports cheaper on the global market. This could spark new trade tensions as Western countries accuse Beijing of dumping products at low prices. That would make the geopolitical game between China and the West even tougher. In short, China's deflation is not only a challenge for Beijing, but also a test for the global economic system. How China handles this crisis will partly decide how the next chapter of the world economy will unfold. For now, Beijing still insists it has the tools to manage the situation. But confidence in markets is fragile, and history shows that once deflation takes hold, it is extremely difficult to reverse the downward spiral. So the key question is not only can China escape deflation, but also at what cost and how long will it take? That is the challenge Beijing must face now.
Investors worldwide are watching carefully because China's slowdown could mean a major shift in global capital flows. If Beijing loosens monetary policy too much, the yuan may weaken, prompting capital flight. If it tightens instead, growth will stall, deepening the deflationary spiral. This delicate balancing act highlights how difficult policymaking has become. Meanwhile, ordinary citizens are already feeling the effects in their daily lives. House prices keep falling, wages stagnate, and small businesses struggle to survive. For many young people, confidence in the Chinese dream has started to fade. They are saving instead of spending, and that only reinforces the deflation trap. It's a cycle that feeds on itself, one that Japan knows all too well from its lost decades. The fear is that China might follow the same path if it can't find a way out quickly. For businesses, this is a time of uncertainty. Many firms have delayed expansion plans or are moving production elsewhere. Vietnam, India, and Mexico are emerging as alternative destinations for investment. This is why economists say China's deflation is not just numbers, but a turning point for the global economy. It's the intersection of finance, geopolitics, and human lives. Because behind every statistic are millions of workers and families whose futures hang in the balance. Factories cutting shifts, students struggling to find jobs, households afraid to spend.